2021, because back, like you said, back then, in 2021, it looked like the Fed was going to keep rates at zero forever. So all these organizations went out and just massively levered up or invested in commercial real estate at these 1% financing levels and 1.5%. And now all those loans are for 30, 40, 50 cents on the dollar lower. And so, yeah, I think the next 6-9 months, that's where it really, and the evidence shows, like in the market, the way things are acting, the way the banks are underperforming, it shows that this is actually a problem coming at us.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Boehm. We've got a can't-miss discussion lined up today, so buckle up for this very important episode. Today, we're fortunate to have with us Larry McDonald. Larry's a multi-time New York Times best-selling author with his most recent book, When Markets Speak. That hit the shelves back in late March. When Markets Speak is an incredibly important read, and we're going to touch on pieces of it throughout this interview. He's the creator of the Bear Traps Report, a weekly independent macro research platform focusing on global political and systemic risk with actionable trade ideas. Financial advisors, family offices, hedge funds, portfolio managers, and so many others all use the Bear Traps Report to help manage global political risk. In late 2006, as vice president of Lehman Brothers, he led his team into betting against the subprime mortgage market, profiting the firm over $2 billion before its demise. He has numerous other achievements and accolades. Larry, thank you so much for joining us today.
Thank you, Gary.
So, Larry, markets move in trends, they move in cycles, they leave clues behind as to their direction and their movements. You know, what's in, what's out, what's mediocre, what's struggling. Markets are speaking if we're listening, as you've pointed out. What is the S&P 500, NASDAQ, commodities, and gold and silver markets saying right now to you? What clues are they leaving behind?
Well, they're saying that the people in Washington are making a big gamble because spending is up 22% year over year. They want to try to keep the economy hot as possible into the election and through the election. And they're not as concerned about inflation as they should be because we had a banking crisis last year. It shocked the system with about 4 or 5 failures, even one more this year. And so they're terrified of kind of that banking crisis, Lehman type crisis. And so they're offering a lot of accommodation behind the scenes, like the Fed's hiked rates, but they're doing a lot of games with the balance sheet. And so what the markets are saying is that there's so much liquidity out there that the Fed's kind of keeping things up and trying to keep the economy up through the election. But they're really willing to deal with higher long-term inflation. So the Fed meeting today, they raised they've each meeting over the last year and a half, they've been keep raising their long-term inflation targets. And I think that's the goal. The only way you get out of say a $35 trillion debt hole is through inflating your way out through what's called financial repression. And they're slowly telling us the truth.
Yeah, Larry, the current stock composition is unlike anything that we've seen ever. In fact, when were the largest 3 stocks ever 20% of the S&P 500 composition? Never, right? So with the composition being what it is right now, what are the risks and how serious are those risks?
Well, that's the thing about risk is people view things like the Russell 2000 because those companies have some, they have Russell 2000 companies have more leverage. In other words, and so historically people, as you get closer toward recession, people are afraid of those types of companies. But there's 2,000 companies in the Russell 2000 around there. It's not exact, like you said. But to have 20% of the S&P's market composition, 3 stocks, people think that's safe, even though in 2019, the top 3 were about 8% of the S&P. So 2019, it was 8 now. So it's just like this crowded thinking, and it's more about passive investing, where Jack Bogle created index funds and the S&P 500, the NASDAQ. And so the higher the stocks go, the more, like, for example, NVIDIA, like 18 months ago, was 1% of the S&P composition. Now it's 7%. So as they juice stocks higher, these big stocks become larger and larger beasts, and it sets up for, a very, very dangerous, because I don't think the average person sitting at home right now understands that their 401k has been hijacked by 3 companies. Like, nobody would really want 20% of their 401k in 3 stocks.
Well, so you talked about passive investing. Trillions are literally flowing out of paychecks and unemotionally into mutual funds and ETFs that their advisors are pointing these dollars into. It's all on autopilot. And like you said, it's inflating some of these equities seemingly beyond measure. So there's clearly risks from this passive investing activity. At what point are these risks going to come home to roost? Like, is it going to be in the near future? What are you seeing with that?
Well, it's so hard to say in terms of exactly when, but I think with the concentration of risk in those stocks and the economy starting to, the Fed's admitting a softer path. So the Fed's admitting that the economy is slowing down. Mm-hmm. And so if the economy is slowing down and people and the boomers now, don't forget, the oldest boomer is 78 years old. And so 10 years ago, the oldest boomer was 68. So now the oldest boomer is a lot older, and so they control about almost 80 trillion of wealth. So I think it's sometime in the next 6 months, a year, that's where it kind of starts reversing, because if interest rates are up this high and you're a boomer, and the boomer, like I said, the baby boomers controlled about 78, 80 trillion of wealth. And so they're going to start moving money more toward fixed income. And that's going to start to unwind this whole passive thing, along with recession risk. If that rises, that will unwind the passive inflows as well.
So, yeah. And so staying on the market a little bit, some analysts are saying that the artificial intelligence run-up looks a little bit like the NASDAQ bubble from 99-2000, while others, they're saying it looks like the beginning of it back in 1995. Several billionaire founders, including Michael Dell, they're on a stock selling spree right now. The CEO of Dell, he's pledging to sell 3 billion shares worth of shares here in 2024, topping a previous record set in 1999 when he sold 1.7 billion worth of his stock. By the way, the internet bubble burst literally the following year after he sold it. In your view and analysis, is the AI trade a bubble, or is it more like the beginning of the tech stock frenzy? And as a sidebar, do you see AI and robotics cannibalizing jobs and escalating unemployment levels, or creating additional growth and value by making it easier for human workers to be more efficient and productive?
Well, the second part of the question is one of these things that's going to take 10 years to really impact. Because right now, if you look at NVIDIA's sales, their sales are very concentrated into a small group of, and a lot of these chip sales are going into hoarders. So if you're Meta or Amazon, you're trying to buy these chips to prevent other people. You're trying to get like a first mover advantage. So there's a lot of buying of the chips, because you can just look at electricity demand. It's moving, but it's nowhere near moving the way the chip sales are moving. So that there's a lot of garbage going on here, where in terms of people are, like, a small group of companies are buying up NVIDIA chips, and that's creating this exponential growth, which looks like it's just phenomenal. But if you really look under the surface, the amount of chips that they sold to, say, Meta, and then you extrapolate, Meta isn't going to spend that kind of money the next 10 years on AI, because it's just so obscene amount. And so it reminds me of 99-2000 in the sense that a lot of the best trades, I think one of the best trades is for the whole AI boom is going to be things like aluminum, things like natural gas. We need a whole new energy infrastructure in the United States, a new power grid. The data centers, like small modular nuclear power, is going to have to basically support a lot of these data centers. And so there's a ton of other trades that are below the surface, but everybody, just like 99, 2000, everybody wanted to be long JDS, Unibase, Global Crossing, and Cisco.
Right.
And so everybody gets into these, but there's like over the next 10 years, there's like 30 or 40 stocks that actually did so much better because they actually are taking advantage of the the revolution, or the new industrial revolution.
So I definitely want to get into the energy side of things from your perspective. But before we get there, I've got a few other questions. So from the 2008 great financial crisis through the pandemic, and even after inflation began roaring, the Fed kept interest rates artificially low, near zero, for the majority of the time until they started raising rates just a few years ago to combat inflation. These artificially low interest rates, it created a lot of malinvestment and distortions in the marketplace that wouldn't exist otherwise had they allowed the rates to find their natural equilibrium. It doesn't seem, though, Larry, as if the consequences to that time has been experienced yet. Do you anticipate consequences to the artificially low interest rates for such a sustained period of time still before us? And if you do, what kind of consequences are you expecting?
Well, yes, and that's a big part of my book, When Markets Speak, because like you said, when you suppress the cost of capital for long periods of time, there's trillions of dollars of commercial mortgage-backed securities that were done at 1 or 2%, and now if interest rates are 5%, those portfolios are worth, say, $1 billion portfolio. If it's 1.5% on that portfolio, now with interest rates of 5%, that portfolio is worth 60 cents on the dollar, 50 cents on the dollar. And you also have the risk of the city. If the city is deteriorated in terms of some cities in the United States, it's just the whole work from home thing has been much more damaging. So so that's where the pain is. But what they're doing is they're doing the extend and pretend, and so there's tons of pain out there. There's a real credit crisis out there. But if the Fed keeps promising rate cuts, and a lot of these people are market. There's an old saying: mark to model, mark to market, and mark to myth. And so there's really a lot of games around if people are hoping on rate cuts, and if the Fed keeps promising rate cuts, there's a lot of gamesmanship around these marks, which it's the chickens are going to come home to roost. It's sometime in the next year. If the Fed goes higher for longer, they will blow up the commercial real estate market. And you're seeing it in some of the banks, like U.S. Bancorp is third as of last night, is 34% off the highs, and other banks like J.P. Morgan are like at all-time highs. And so Zion, same thing. Zion's is a big commercial super regional bank. They're 40% off the highs. And so there's no question that there's this like lurking credit crisis in some parts of high yield, in some parts of the big ones are private credit, the lending on the private credit side. So imagine like for like the last 100 years, the banks have been the lender, right? And then all of a sudden then came credit card companies, and there's all these different types of creative lending. And now you have companies to do the buy now, pay later lending and all this. But on the other side, there's this private credit, which is lending money to all kinds of companies and all kinds of organizations in the private market, and it's not well tracked at all. So we've got this credit crisis, but it's if the Fed promises higher for longer, they truly, like you said, look at today, they're promising like to keep a year from now for the Fed funds rate, they say is going to be still 4%. So like a year and a half from now, 4% Fed, but that'll probably blow up some commercial real estate, exposed banks.
So it sounds like, I don't want to put words in your mouth, but it sounds like what you're saying is that this extend and pretend can only last for so long. They can only push this out for so long before they either run into a problem with the higher rates or they have an issue on the downside.
Yes, and we know this is the case with like Bank of Montreal earnings 2 weeks ago. They announced some problems. OZK, there's a bank in the Ozarks. There's all these different banks that have admitted, New York Community Bank. So we've seen tons and tons of evidence that this is a slow-moving problem. But companies like MetLife, MetLife has $650 billion portfolio of investments, and $100 billion of that is in commercial real estate. And they basically doubled their down in 2021 because back, like you said, back then, in 2021, it looked like the Fed was going to keep rates at zero forever. So all these organizations went out and just massively levered up or invested in commercial real estate at these 1% financing levels and 1.5%. And now all those loans are for 30, 40, 50 cents on the dollar lower. And so, yeah, I think the next 6-9 months, that's where it really, and the evidence shows, like in the market, the way things are acting, the way the banks are underperforming, it shows that this is actually a problem coming at us, and it's not that far away.
So the market usually is about 6 months in advance. So you don't think the market, though, is showing it yet? It's not priced in yet, is it?
Well, that's the thing. If you look, the crazy thing is like the index, to your point, because it's 3 stocks or 20%, the indexes are all-time highs, but the regional bank indexes and all these other things are showing a lot of pain, like a lot of, or Capital One, for example. Capital One is underperforming American Express. Now that's credit. It's on the consumer credit side, but there's all these divergences where companies that are exposed to the bottom 60% of consumer, or the companies that are exposed to commercial real estate, are underperforming the market by the most like we've ever seen.
So some of the pain is being masked, is what you're saying. Yeah. So, okay. So Larry, in your book here, When Markets Speak, you write about the decline of the U.S. dollar. What exactly do you see coming for the U.S. dollar, and in what time frame, and how do you see it affecting us everyday citizens?
Well, we have a team in Washington that is so grossly irresponsible over the last decade, and it's both sides of the aisle. But they keep getting bailed out by the global, like now we have political risk because we have surprise elections in France. Macron, there was a headline today, Macron, they were trying to push Macron, the president of France, to resign because the election was so bad against him. And so that political risk has created like some demand for dollars that, like, because the US is viewed as somewhat more stable than Europe. But so that's one of the things that's holding up the dollar. The other thing that's holding up the dollar is the Fed promising higher for longer, because if you're promising 5% Fed funds, and so that's T-bills that are paying 5% on the front end of the yield curve, so you're giving all investors in the world, anybody that wants to buy a 1-year T-bill can get 5%. That's going to suck money into dollars. That's going to keep the dollar up. But the moment the Fed, has to get interest rates lower, because right now interest on the debt is now $86 billion a month. $86 billion a month. A year ago, there was like 58, 60. So $86 billion a month. That's over well over $1 trillion a year in interest, and that's growing.
And I think it's heading to 1.7 is what they are projecting.
Yeah, I mean, if that's the whole point. If you go higher for longer, that goes to 1.7, and that blows up the Treasury, and so that's why they have to get interest rates down, and and once you bring interest rates down, the dollar becomes less attractive, and that's what's going to get you the real much weaker dollar.
So you've touched on this 5%, and you've touched on the regional banks. I've got a question that's going to kind of combine both of them. You recently tweeted 5% of T-bills are breaking the regional banks. PIMCO expects more regional bank failures in the U.S. because of a very high concentration of troubled commercial real estate loans on their books. The real wave of distress is just starting. Also, Moody's just downgraded some regional banks, and they're instructing that as many as 130 of them are affected. How much of a threat does this commercial real estate situation really pose to both banks and the economy, in your view?
Well, it's a lot, because it's a big threat, because at the same time, the transports are acting really poorly. So the Dow transports, the truckers, Old Dominion, they're underperforming the S&P by a lot, and they're always like a classic, canary in the coal mine, the transports. Like I said, the regional banks are underperforming because of commercial real estate, but also the consumer discretionary stocks. So if you look at McDonald's, or you look at Home Depot, or you look at companies like Starbucks, there's dozens of of
Right.
companies that are down 10, 20, Darden restaurants, dozens of companies that are down 10%, 20% over the last year or on the year. And so if you get the commercial real estate thing at the same time where the consumer is weakening because of these higher rates, it presents a huge problem, and that's going to force probably a year from now the Fed's going to have within the next 6 to 9 months the Fed's going to be forced to cut, I think, 200 basis points off of this, and that's what's going to get you the real move into hard assets, gold, silver, but for right now, if they keep the 5% T-bill up there, and they're slowly breaking the banks and they're slowly breaking the consumer, but that's keeping the dollar up, and that's really preventing a big move higher in a lot of different metals.
Interesting. Well, I definitely want to touch on this rotation concept here in a little while. But Larry, tectonic plates in our country and economy seem to be shifting pretty strongly. We've got this aging population you touched on a moment ago. The current political form of government is absolutely historically unpopular. Unfunded liabilities are off the charts. The national debt, which you've touched on, is a crazy heavy burden, especially at these higher interest rates. We're running $1 trillion deficits every 100 days or so. And, we can keep going with this list. What is the way out of this mess, though? I think that's what everyone wants to know.
The way out of it is what's called financial repression, where if you keep interest, say here's your interest rates, and if inflation runs, then here's your inflation, here's your interest rates. If over time, if they can push interest rates down below the rate of inflation, they will get rid of the debt over time because they'll inflate their way out. It's called financial repression. But there's no way out of it besides that. I guess you could have, if you had this booming economy that was growing at like 6-7% a year, you could grow your way out of this too. But we like you said, we've done about the fiscal and monetary response to COVID and the banks was 16 trillion. The fiscal and monetary, so the COVID crisis plus the banking crisis, though, last year and this year, 16 trillion of fiscal and monetary. And the response to Lehman was about 4 trillion. So that 16 trillion is supporting the economy, but it's amazing how even after that 16 trillion of fiscal and monetary, we still see all this incoming economic weakness, and that's because of the higher rates, the impact on the banks, impact on the consumer. And so, yeah, we're not going to get bailed out of this by some, growth miracle of 6-7% GDP.
So today is Fed Speak Day, and on that topic, Canada's central bank recently cut interest rates. They're the first G7 nation to do so. And outside of the pandemic, it was their first cut since the 2006 to 2009 GFC time period. Today's CPI print seemed to be kinder, despite Shelter's higher number, but it does feel like the Fed is getting closer to a cut. Is Canada's interest rate cut the beginning of a new trend for Western central banks? Is the clock now ticking for the U.S. Federal Reserve to cut rates? And what do you see as the resulting effects on the various asset classes when they do? Yeah,
I completely agree. The Bank of Canada is always like the stepchild, or they'll run the course. They're basically giving the Fed cover, and they work together. And they also have a huge problem up there with the housing and with the cost of housing. And with their mortgage rates are not like ours, and there's no such thing as a 30-year fixed mortgage in Canada. But so it's like it's like a rolling 5. So they have a huge, and you can saw it with Bank of Montreal, the earnings last week. So you can see this big crisis that's kind of brewing. They got to get rates down. Yeah, so they're kind of like the leading indicator for what the Fed's going to do. And yeah, they're first to cut, and the Fed will be right behind them.
So what are you seeing for the asset classes once the Fed does start cutting?
Well, once the Fed starts cutting, then once again, the Fed funds rate or the T-bill rate will come down, or 2-year treasuries. So the Fed funds rate controls the front end of the yield curve. So all those 1-year treasuries of 2 years doesn't control the long end. So if they cut rates, the entire front end of the curve comes down. The curve will steepen. So the front right now, the 5-year, the 2-year treasury is yielding about the same as the 30-year. But if they cut rates, the curve will steepen. So then it's not as the dollar's just not as attractive, because they don't have that huge short-term guaranteed riskless 5%. And so that, plus an economy that starts to roll over because of commercial real estate and other things, wounded consumer, the bottom 60% of consumers, that gets you into this cutting regime. And then what happens when you go into that weaker dollar and cutting regime? That's when silver, platinum, palladium, copper, oil and gas, all these types of stocks like the XME, global value, we call the EWU portfolio. That's another ETF that focuses on. So global value will start to outperform what we call disinflationary portfolios, which are growth stocks and tech stocks and bonds. In that kind of a rate cutting world, hard assets and value and emerging markets will all outperform. And so you see right now there's about 22 trillion in the NASDAQ 100, and probably 4 or 5 trillion comes out of there and moves into other assets.
That's amazing. That would be a huge bubble of money coming from much smaller asset classes. Staying with this rate cut idea, I mean, here we are, we're mid-June almost. The presidential election is in November, so we're talking just a few months away. Can the Fed actually get away with a rate cut without looking political at this point?
Well, they'll need some help from a banking problem or unemployment that really kind of accelerates higher. So they're going to need some help. Right. Other than that, if they don't get some help, we won't get a cut till just right now. The probability of September cut is slightly higher today because of the CPI number, but the Fed probably just cuts after the election, and that'll probably be too late, and then you'll get a whole bunch of cuts next year. You'll get like over 100, potentially 200 basis points. But they want to cut, but they don't want to seem political. But they'll do any chance they get to cut that comes from a banking problem or comes from unemployment, they will cut aggressively.
So at this point, they're just looking for an excuse, is what you're saying.
Oh, yeah. And if you look at what they're saying in the statement today, like they're saying that unemployment is going to be 4% for like the next unemployment is going to be 4% for the next like year. And so they're not admitting any kind of economic stress or weakness now. And once they do, then that'll open up the door to much more aggressive cuts.
So you're talking about unemployment. The unemployment rate has been in low record territory for several years. Every report that comes out is performing better than expectations, although it does get revised down, a few months later in the future. It doesn't seem, though, that is impacting the unemployment rate. More people in decades, though, are working an extra job or 2 part-time jobs instead of one really good full-time job. A Bloomberg economics reporter, Anna Wong, she recently wrote a column stating that the Fed has overstated job numbers by at least 730,000. And then right after she released that, the JOLTS report came out, and it showed that job openings have absolutely cratered. So what is all of that data saying to you about unemployment and jobs, and where do you see that going? I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and every single expert interview that we conduct, just like this one. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive this free gift on us. Also, I'm positive that you've enjoyed this conversation with Larry as much as I have. Please let him know. Hit that like and subscribe button and leave a comment below the video.